Stocks mostly higher today with the S&P 500 and Nasdaq closing at records as President Trump announced the framework of a trade deal with Vietnam. The gains coming despite some weak jobs data. ADP private payrolls unexpectedly fell by 13,000 in June. The Labor Department jobs report comes out tomorrow morning. For more on what it all means for markets and the Fed, let's bring in Jack Janasiewicz, lead portfolio strategist at Natixis. Jack, great to see you.
Thanks for having me back.
Where do you stand on where we are in the markets right now? Fully valued, overvalued?
You know, I think the big risk going forward here over the next couple of months really comes out of that labor market. And that's why I think tomorrow's payroll print will be somewhat of a turning point here. You continue to see ancillary data showing potential weakness coming out of that jobs market. And the Fed seems to be at least sitting on their hands in the interim. And so you could get a little bit of a weakening in the labor market. The Fed a little bit maybe slow to react to that. And as a result, maybe you get a repricing in the near term here, knee-jerk reaction of maybe the growth scare kicking in. And as a result, maybe we get a little bit of a sell-off in the interim.
Oh, I would have gone the other way, Jack. And I guess this is sort of like a Rorschach test. If the jobs market came in weaker, that would underscore the need for the Fed to actually cut. And so, therefore, the markets would like that.
Yeah, I think there's a timing mechanism there, and I think longer term, I think that's probably the right the path to take. And I think before we went to break there, Mike Santelli was sort of walking through the same case that we were outlining. So my guess would be that maybe the knee-jerk reaction right off the bat on a weaker payroll print would be a sell-off. But again, the market would then start to probably reprice in higher rate cuts going forward. And so give it a little bit of indigestion in the interim, and you're probably looking for a pretty good setup into the end of the year.
Jack, I saw from your notes that you're neutral to slightly underweight on the equity side. What about this rotation of this week, though, at least is encouraging to you? Do you believe that there's opportunities in some of these sectors that have had a pretty good week and have not been the obvious Mag 7?
Yeah, I think it's a little tricky because you're looking at, the quarter end potential rebalancing here. And so, we certainly saw yesterday it was sell the winners, buy the losers. You got a little bit of that pull through even today. You've got small caps which were doing well on the back of higher rates. So that kind of makes you squint and say, I'm not really sure what's going on there. So, I still think it's more of the same. You're going to have the growth complex likely continuing to lead going forward. And I still think, and you guys were just talking about this, the tech complex, the comm service complex, and even maybe outside of that, the financials continue to sort of be the leadership as we continue to push into the end of the year. So, I think it's still more of the same in here.
Jack, continuing along the theme around equities, can you kind of speak to how you're balanced between U.S. domestic and international stocks? We've seen quite a bit of a rotation or broadening out, if you will, from U.S. domestic to more Eurocentric or international stocks. Can you kind of give us your view on what that proper balance is and, where you start to see money flows going into the second half of the year?
Sure. And I know we've had a pretty good rally in European equities, for example. And I think a lot of that was just a function of positioning, right? You've had some pretty big overweights that probably got extended because the tech trade has really been that leadership factor going forward for at least a couple of years now. And so a lot of investors probably overweight where they probably would like to be from that perspective. And given the sort of the Trump news and off of Liberation Day, it made some sense, I think, to rebalance back to something more normal. But I'm not sure that we're having a dynamic change underneath the surface here where you're going to see Europe continue to lead. Where do you get growth in earnings coming from? It's still coming from that tech complex. And when you just look at the constituents within the indices there, that still favors the U.S. equity market. And so we're not necessarily buying into this idea that, you should start to be allocating and this is sort of Europe's time to shine, so to speak. We still think it's a U.S. story, and the growth, that backdrop is still supportive for U.S. equity. So still overweighting U.S. equities and underweighting international in our portfolios.